If your crews are booked out, the trucks are moving every morning, and the bank account somehow feels tighter than it should, the problem probably isn't sitting in the work you're missing. It's sitting inside the work you already have. A full schedule feels like proof the business is healthy because the phone keeps ringing and everybody has somewhere to be. But that feeling falls apart at the end of the month when you look at what's left and can't explain why all that work walked away with so little left behind. I've watched this play out in field operations more times than I can count, and it always looks the same from the yard. The trucks are moving, jobs are closing, revenue's hitting the account on schedule. The owner feels a completely different version of the same month because payroll, material, fuel, insurance, and repairs are all pulling from that exact same pile of money. More work came through the door, the pressure never eased. That gap between what the schedule shows and what the owner feels is the whole lesson. Busy tells you how much activity a company can produce. Profit tells you whether that activity was worth the time, cost, and the risk. Those two numbers can move in completely opposite directions, which is exactly how a company posts its best revenue month on record and hands the owner less control than he had before. The three numbers that you're probably mixing together. Here's what most contractors lose the thread, and it happens before a single job even gets reviewed. Revenue, cash, and profit get used like they're the same word in daily conversation, but they're not. Revenue is what you sell the customer. Cash is what's actually landed in the account. Profit is what's left once the work paid for every cost it created along the way. A job can generate revenue before the customer ever pays a dime. A payment can hit the bank before you've covered a single cost tied to that same job. That's why the bank balance lies to you for a few days at a time. It feels good right after a deposit clears, and then it drops the moment payroll and suppliers pull their share out of it. The money didn't disappear. It was never yours to begin with. Part of every deposit belongs to the job before it ever belongs to you. And until the business separates money that's just passing through the account from the money that's actually earned, that balance will keep telling you a story that just isn't true. Most contractors already track revenue because it sits right there on the sales report and the deposit list. Profit takes one more step nobody wants to take, comparing what the job sold for against what the job actually used to get done. Skip that step and a full schedule can hide a lot of weak work behind one impressive top line number. The job looked fine until it wasn't. Let me put some real numbers on this because that gap is easier to see than it is to explain. Job sells for, say, $10,000. Your material runs you $3,000. Field labor looks around $2,000. Equipment and outside help add another $500. On the estimate, that leaves you about $4,500 before you even touch overhead and a genuinely strong-looking job the moment the customer signs. But one piece of the scope got missed. The crew needs an extra day. Labor adds $1,000. Extra material adds another $700. A rental sits on site long enough to add another $300. The customer price never moves off $10,000, but the amount left before overhead just dropped from $4,500 to $2,500. Half the expected margin gone, and the invoice looks exactly the same either way. Here's the part that should bother you. Nothing on the schedule tells you any of that happened. The calendar shows the same customer, the same sale, and the same completion date. The crew drives off with a happy customer and a sense the job went just fine, while the business just gave up nearly half of its gross profit it was actually counting on. One job like that probably won't sink your company, The same miss repeated across 10 jobs? Absolutely will. Lose $2,000 of gross profit 10 times over, and you've lost $20,000 without losing a single sale, which is exactly how a whole team can work hard for a month and watch the account give them nothing back for it. The schedule stays full. The revenue report looks great. The owner's first instinct is almost always the same. We need more volume. But more volume isn't the fix for a leak you haven't found yet. It just runs more jobs through that same hole. What job costing is actually meaning here? This is where job costing earns its place. And I want to be clear about what I'm not talking about. Not a 3-hour accounting project per job, not a report nobody reads, a plain comparison between what you planned and what actually happened, done close enough to the work that people can still remember why it went that way. For a first pass, take the selling price and subtract direct labor, material, equipment. If you add subcontractor costs and anything else tied specifically to that job, what's left is gross profit before overhead. Your accountant can help you build the full model later, but you don't need a perfect system to notice a job burned twice the labor you budgeted. All right, material that never made it to the estimate in the first place. Do this near closeout, not 3 months later. Way too long and the numbers survive, but the reason behind them doesn't. The tech won't remember why labor ran over. The office won't remember which part of the scope changed mid-job. You end up staring at a weak margin with no useful answer attached to it. Just a number with no story, which is worthless. If this is the part of your business you've never actually measured, that's exactly the gap the free cash recovery kit is built to close. Gives you a simple way to line up, plan a result without turning it into a bookkeeping project. It's worth running your last few jobs through it while we keep going. Links below. Because once you start comparing plan to result, one place shows up more than any other before the crew ever touches the job. The first place I'd look is in the estimate, because a lot of margin disappears before anyone ever picks up a tool. Most prices don't come from a cost breakdown. They come from habit. What a service call sold for last year, what the guy down the road charges, whatever number tends to get a yes without much pushback. That approach can tell you something about the market, but it can't tell you what the job actually requires from your business. Labor rates move, material costs change, insurance, software, fuel, repairs, office support, payroll, taxes, none of that freezes in place just because a price felt normal for 2 years running. A rate that worked fine back then can leave almost nothing today, even when the crew executes the job perfectly without a mistake. Scope creates the same hole a different way. Quote covers the visible task, the install, the repair, and the obvious labor, but it leaves out travel, setup, cleanup, permits, equipment, office time spent scheduling and following up. None of that has to show up as a separate line on the customer's proposal, but it has to be baked into your price, or the job starts with a margin that never actually existed. And that's an important distinction, because when the estimate counts the visible work and ignores everything around it, the crew gets blamed for a missing number they were never given a real shot at hitting in the first place. The review has to separate a weak estimate from weak field performance, or you'll spend months fixing the wrong thing. Estimating is where margin gets set. Labor is where it gets spent, one small piece at a time, in ways that never feel serious in the moment. A crew waits on access, searches for a part, has to drive back to the shop, calls in for missing info, stands around while somebody figures out how to handle a change nobody for. Each one of those might cost 20 minutes. None of them feel worth mentioning. The job absorbs every single one anyway. Sometimes the crew isn't slow. The target was wrong from the start. When your best techs consistently need 10 hours for work priced at 6, it's not a discipline problem. That's an estimating problem wearing a labor costume. Push for more speed against a target that was actually never realistic, and you'll turn a strong crew into one that looks weak on paper. And every job review is going to turn into an argument that fixes absolutely nothing. The question that actually helps isn't who took too long. It's what caused the time to slip past the plan. A missing part points to prep. A scope gap points back to the estimate. The same skill gap showing up job after job. That's one's actually training. And now you know where to spend the effort instead of guessing. That distinction matters more for your team as it does for your margin. It lets people own the part they actually control instead of absorbing blame for a price, a scope, or a schedule that failed before the job ever reached them. Not every job on your board is the same job. This leads me to another leak, and this one's invisible on the schedule in a completely different way than the others. It's not a bad price or a slow hour. It's the type of work filling your calendar in the first place. Some jobs fit your team, carry a real margin, and move through the business without much friction. Other jobs look identical on your revenue report. Same box on the calendar, same sale, while quietly consuming travel time, management attention, equipment, and schedule space that could have gone somewhere better. A full calendar hides the difference completely because every job takes up the same size box. One job produces a solid gross profit with almost no trouble. The one right next to it eats twice the attention and leaves almost nothing after direct costs. The schedule calls both of them busy. The business gets a completely different result from each. I'm not telling you to turn down every small job or chase nothing but the biggest ticket in town. Small jobs build repeat customers. Fill open time, keeps the cash moving. The real question is whether you know why a job earned a spot on the board. Is it because margin, relationship, training value, filling time that would have sat empty otherwise? Or whether it's there out of a pure habit, with nobody ever checking if that type of work gives back enough for what it costs you to run it. If strong revenue keeps turning into weak cash or thin profit, that pattern, a good top line number, thin results, is precisely what the cash recovery kit is built to trace. It won't replace a real job costing habit, but it'll show you several of the gaps that hide easily during a busy month. Links below when you're ready for it. What you pay yourself isn't what the business earned. This leak is the one that fools owners the longest because it doesn't show up in the job numbers at all. It shows up in your own bank account and it looks exactly like good news. You can draw money out of the business during a busy month and call the company profitable without ever confirming the business earned enough to replace equipment, survive a slow season, cover your taxes, or fund whatever's supposed to come next. Getting paid feels like proof, but it isn't. Paying the owner and building a business that can carry itself are two completely separate outcomes. And one of them can happen without the other for years before anyone notices. A healthy job does more than cut you a check. It helps you carry overhead, protects the company from the next slow stretch, and still leaves something behind after all of that's covered. If the only thing a busy month proves is that you got paid, you haven't actually learned whether the business got stronger or you just got lucky with timing. That's why busy doesn't mean profitable. And I want to be clear, this isn't a shot at how hard your people work. Most contractors have crews showing up, solving real problems, carrying more responsibility than anyone outside the trade gives them credit for. But the issue isn't effort. It's that effort can hide a weak result perfectly well when nobody goes back and measures the job after it was done. Your team can take real pride in the work the company priced wrong from the start. The customer can love the result while your margin quietly disappears underneath it all. The schedule stays full while the business gets weaker, which is exactly why another speech about working harder is never going to fix any of this. So, how do you actually run this review? A clearer view of how the work fixes it. Here's how you build it. Pull 10 completed jobs from last month. Choose a mix that actually looks like your normal week, not the cleanest jobs, not the biggest invoices. You're trying to understand the business, not defend it to yourself. So for each one, write down the selling price, planned labor, actual labor use, material costs, equipment, or subcontractor costs, and anything that changed the scope after the estimate went out the door. A spreadsheet handles the math fine. A legal pad works just as well for a first pass. The tool matters less than getting the plan and the results sitting next to each other where you can actually see them. Once the numbers are on the page, calculate what each job left before overhead. Then write one sentence per job explaining why the result landed above or below the plan. A strong job might show the estimate matched reality and the crew had what it needed. A weak one might trace back to one bad assumption, one missing material item, or one piece of the scope that never made it into the price. That sentence is what turns a number into an actual decision. A miss with no reason attached just sits there, but a miss with a cause tells you whether to change the price, the prep, the training, or the type of work you say yes to next time. After all 10, group the results by what caused the leak instead of by job. You might find one service consistently priced low, material runs that keep adding hours nobody accounted for, or scope that changes that never make it back to the estimate. You might also find one type of job that eats far more management attention than it returns in margin. The pattern is what gives you something to act on. A weak price needs a new estimate built off current cost and not pep talk. Labor drift tied to prep needs a better job package before the truck leaves that morning. A service that keeps missing margin might need a new price, a new process, or honestly, just less room on your schedule for it. Fix one pattern and every job of that type improves without asking anyone to work a longer day to get there. The business doesn't need to get less busy. It needs to get more honest about what's actually filling the calendar and what that work costs to run it. That honesty changes the conversation you will have with your team too. Telling people the company needs more profit is very vague because the field doesn't control every piece of the outcome. A tech can't fix a price that was wrong before the job was ever dispatched. The office can't prep material for scope that never reached them in the first place. A real job review splits that up cleanly. Estimating owns the labor and material assumptions. The office owns the customer information in the job package. The field owns execution and communication the moment something changes on site. And you own the decision that comes after. What gets fixed and in what order. Everybody carries their actual piece of it instead of absorbing one vague demand to move fast. Speed was never the answer here. Pushing people through the day creates mistakes, rework, and a callback next week that costs more than whatever time you thought you saved. A crew that finishes in 8 hours after real prep creates more value than a crew rushed through in 7 with a return trip already waiting on the books before they get back to the shop. Run this 10 job review beside the free cash recovery kit, and you'll be able to tell the difference between work that's sold with weak margin baked in it from the start and money the business already earned but hasn't finished moving through the process yet. Links below when you're ready to run both side by side. More sales absolutely belong in your plan once you actually know what you want more of. If your last 10 jobs show solid margin, your team has real room, and the process can carry more volume without losing control or adding demand, and it's exactly how you grow. The risk is stacking more work on top of a process you haven't checked yet. More work multiplies whatever's already sitting inside it. Good pricing gets more chances to produce real profit, and weak estimates get more chances to quietly take it back out. Let the schedule follow what the numbers actually say instead of hiding behind them. One small addition to whatever you already track each week handles this going forward. Keep watching sales and revenue like you always have. Add a short review of completed jobs, what missed plan, what beat it, what taught you something either way. Ask what you expected, what actually happened, and what changes before you sell that type of job again. Once the data's ready, a conversation takes 15 minutes, not a full afternoon. Field work will always come with surprises. Conditions change, customers add scope on the fly, material breaks, estimates miss things nobody could have caught in advance. None of this is about pretending every job lands exactly on the number. It's about catching the same miss before it quietly becomes part of how your business normally operates. A company can absorb one bad job without blinking. It starts to struggle the moment that same bad job gets sold every single week and nobody ever goes back to check why. Your schedule can absolutely be a good sign. It just isn't the only sign that matters. And it's the one that's the easiest to mistake for the whole picture. So this week, pull your last 10 completed jobs, run them through this review, and find the pattern that repeats the most. Fix it first. And tell me in the comments where your margin tends to leave the job. Is it estimating, labor, material costs, or the type of work your schedule is filling in the first place? And download the free cash recovery kit through the link below. Run it beside your 10 job review and start finding the money your job and your schedule may be hiding. And you can find this at TradeStackDigital.com.